Jim, there is a lot of exuberance in the markets on the US, on prospects of the US economic recovery. Do you see the recovery in US economy is purely cyclical in nature?
Well, the US has gone through a firm patch on economic data. There's no doubt that the labour market has picked up somewhat. We think capital expenditure has improved on the back of good corporate profitability. But it faces one significant hurdle, and that's that the interest rate signal from the central bank, which is left close to zero, is telling businesses to be very cautious about their expansion, to be very cautious about their hiring, because it really signals that there's no growth coming in the future. So we think that the US is doing okay, but that okay really amounts to about 2–2.5% GDP growth going forward, which is hardly exciting.
Jim, so what's the probability you're assigning to US or Israel actually striking Iran? And should this happen, where would we expect oil prices to go?
Well, there's no telling what the US and Israel might do if Iran were to announce that it actually had nuclear weapons. They're certainly very much against that prospect. And if that were to come through and they were to take military action, then of course oil prices would be probably at least $50 higher than they are just now, given the threat to the Straits of Hormuz and to overall Middle East production. So let's hope that it doesn't happen, because another $50 in oil prices will guarantee a global recession this year.
Jim, so if the global macro picture indeed is beginning to looking bleak, would you once again bet on precious metals and especially gold? And then what is your outlook for gold in this current calendar year, which is 2012?
Yeah, I don't think the global macro picture has looked anything but bleak this year. The US is doing okay, as I say, 2% growth, nothing to write home about. But Europe is going to be in deep recession. Even the ECB is talking about -0.1 now for European growth, while we think they're out by a factor of 20. It's going to be around about -2, maybe between -2 and -5, with emerging markets slowing pretty dramatically as well, China, Brazil, others. So the prospect for commodity prices, well, gold in itself really much more dependent on central banks, and of course there's plenty of money printing around in them, so we continue to be long gold and we continue to recommend it. Industrial metals, on the other hand, things like copper, iron ore, etc., we expect to be falling in price pretty dramatically this year.